Debts must be paid. That's a fundamental truth. A saying we couldn't be more familiar with. But in reality, people have discovered it seems to only apply to individuals and not to large corporations. For them, bankruptcy can be restructured, debts can be extended, or even forgiven. Even when losing money, they can still continue to raise capital. The more money you have, the easier it is to borrow. Only individuals have to pay their debts on time. If you miss one payment, it gets marked on your credit history. This is the first contradiction that many people feel. Getting something for nothing is shameful. Just as the saying goes, heaven rewards the diligent. This is also something we often hear. But then we find out many people don't earn money through labor. They earn it from interest, dividends, and speculation, and are even considered smart and sophisticated. This is the second contradiction that many people feel. These two main contradictions, piled on top of the pressures of our fast-paced daily lives, have morphed into a kind of illusion that capital can be used to generate money as if it can multiply without any labor, proliferating infinitely as long as I have money to lend. I can get something for nothing. Faced with this illusion, people might vaguely feel that something isn't right, but can't quite put their finger on what it is. Regardless of right or wrong, they feel they're the ones getting the short end of the stick. So they start to scorn the old adages, calling them toxic platitudes and giving rise to many cynical views. Everything is about money. Poverty is the original sin. Possession is success. The ends justify the means. I think this is also why today, During is screaming as he returns to the stage. Whether it's an illusion or a platitude, its root lies in the fact that these mainstream theories ignore that the range of choices most people face is limited, yet they assume people are free to choose. Without ever mentioning that, both historically and today, most loans are not used for productive purposes, mixed in with countless speculative activities. Most wealth cannot be obtained simply by working hard, but rather through inheriting beneficial privileges or from land rents or profits generated by monopolies. Encouraging and motivating people to actively strive for more is not wrong at all, but a complete theory should not be made ambiguous. Otherwise, it can be easily cherry-picked by its beneficiaries, misinterpreted, and exploited under the pretext that it's always been this way. Once this exploitation becomes widespread, in practice, it will inevitably backfire. And the price to be paid is that people lose faith in the order that was painstakingly established, and instead turn to believe in an alternative that is more extreme and irrational, even if that alternative was once mercilessly criticized throughout history. But it still seems more real than the artificial order. All of these things, in their push and pull, form the ultimate paradox. People always assume that history will filter out the irrational and the barbaric, discarding them. But clearly, when it comes to the issue of distribution, old narratives can sometimes truly be dressed in new clothes. And this brings us to our fourth installment on Volume 3 of Das Kapital. Through the first two volumes, we've understood the circulation, turnover, and flow of industrial capital, as well as the dependent and distinct nature of commercial capital, for example, price without value. These two factors both reinforce and restrain each other together, forming a distribution structure of a steep wealth pyramid and class rigidity. And this structural contradiction, in turn, leads to cyclical conflicts. Let's summarize the points we've discussed before. In a non-ideological way, capital-intensive production displaces labor, surplus unemployment, and cyclical conflict. But we still haven't touched upon other important areas: credit capital and land rent. They are the historical precedents of today's financial capitalism and will also be the focus of our next installments. Let's start with a question. Ultimately, what can money do? To put it more precisely, what function does money ultimately serve? First, you can use it to buy clothes, eat a meal, watch a movie, and so on. In this case, money is merely a medium of exchange. You can also use it to open a factory, buy machinery, and hire workers. In this instance, money is not just a medium of exchange, but also a tool for expansion, and through the circulation and flow of its three forms, it becomes capital itself. But what if we don't see money as an intermediary, but as a commodity in its own right? A special kind of commodity. In that case, we get a special form of capital. Interest-bearing capital. Someone might ask, Who would be idle enough to use money to buy money? Yes, it sounds quite absurd, but what if we add a step and reverse this formula? First, let's treat money as a special commodity that is loaned out to someone in need under an agreement. After the term expires, the other party must not only return the principal, but also pay interest. Now this becomes logical, and the reason we call it a special kind of commodity is that besides its exchange value, which we just mentioned, it also has a use value. Its use value lies in its ability to appropriate a portion, i.e., the interest, of the surplus value created by the borrower. In layman's terms, the use value of interest-bearing capital is precisely its ability, as capital in the act of creating more value, that is, to proliferate. On the surface, interest-bearing capital seems to have a natural ability to reproduce. No production needed, no labor needed. Just by waiting for the term to end, it grows. But the question is, the source of this value increase, i.e., the interest, where does it come from? Explaining the theory directly here would be a bit abstract. So let's use an example. Suppose you lend $1 million to a factory owner. He uses this money to buy machinery, raw materials, and hire workers, producing goods worth $1,200,000, creating $200,000 in surplus value. According to the agreement, he needs to pay you $50,000 in interest. But this $50,000 wasn't automatically generated by your capital. Instead, the factory owner, through the actual production process, deducted a portion from the surplus value created by the workers and transferred it to you. Do you see it now? In this process, if we deliberately obscure the core link, who is working, who is exploiting, then money creates an illusion similar to a chicken laying an egg, and the egg hatching a chicken. And the essence of this illusion is the exploitation of labor. Interest is merely a portion carved out from the surplus value. And surplus value itself is the true source. It is the portion of value that workers create during the production process that exceeds their own wages, but is appropriated without compensation. At this point, let's address a common misunderstanding, which is also a form of ideology. This is a point many people question and are easily misled about. They say, you keep talking about the worker's surplus value being appropriated by the capitalist without compensation, which constitutes exploitation. But what about the capitalist having to bear risks, investing large amounts of capital, and having to manage and make decisions? Why don't you mention that? On what grounds does the surplus value not belong to them? This relates to the bourgeois rule of law, which we'll discuss in a future installment on Lenin's The State and Revolution. Its essence actually corresponds to the first transitional phase that Marx mentioned in his critique of the Gotha program, which is that distribution must still be based on labor. This rule of law, on the surface, treats everyone equally, promoting a formal equality where you reap what you sow. Whoever invests gets the reward. It seems neutral. But in reality, it's a cover-up for an unequal social structure. Its essence is to disguise the privileges gained from monopolies on property, class status, power, and other social conditions as a natural order that anyone can participate in and achieve through effort. And those challenging questions are typical manifestations of distribution based on risk, distribution based on capital, and distribution based on class. They attempt to use a logic that appears fair to conceal capital's appropriation of surplus value, but this is the crux of the issue. The capitalist mode of production is itself built upon unequal social relations. This means that distribution under capitalism is not based on who works harder or who tries harder, nor is it based on so-called brilliant decisions or risk-taking. Instead, it's based on ownership relations. Whoever holds the means of production, whoever possesses the capital, holds the power. So-called risk is not an essential premise of capitalist activity. He has the right to invest and the right not to invest. This is a right, not an obligation. More importantly, risk itself cannot directly create value. Only labor can create value. On the surface, it's he who takes the risk, gets the reward. The bigger the waves, the more valuable the fish. But the one who bears the risk is not the same as the one who produces the value. These two things cannot be equated. It's very important to see the origin clearly because it corresponds to the question of whether The acquisition of surplus value is built on the foundation of getting something for nothing. Let's use the crudest, yet most understandable analogy. If we say that taking risks, buying means of production, making decisions, and investing capital allows one to legally plunder, then aren't pirates also investing by risking their own lives? Why don't we encourage dividing the spoils based on risk? As for the idea that whoever invests gets the profit, it sounds fair and reasonable. But so-called one's own capital is actually the crystallization of social labor. For details, see the installment on Volume 1, Part 1. Any production and commercial activity needs to be profitable. There is nothing wrong with that. It can receive returns and profits, but this cannot be based on rules and regulations that push workers' wages below subsistence levels and be realized through the continuous appropriation of the unpaid portion of workers' labor. Similarly, the tune of the more you invest, the more you get is the same. It disguises the privilege of holding capital as a contribution of labor. Everyone must pay close attention. Possession is not the same as creation. Investing more is possible because one already possesses the crystallized labor of many other people. Its essence is still the possession of the means of production and the so-called equality they constantly proclaim, in reality, has never truly existed between capital and labor. Why? Because the starting point is already unequal. One side sells their own labor power for survival and is forced to enter the market. The other side, relying on capital, can set various conditions to devalue the value of labor power and can even create unemployment. This narrative that disguises inequality as natural and just is a typical form of ideology. And all of them are built on a common foundation, the private ownership of capital. And this premise, as I mentioned at the start of Part 6 of Volume 2, capital is not a thing, but a relationship of domination. This is the problem with one side of the distribution argument. Similarly, its other side is also where many people today often mislead public opinion. They completely ignore the major premise that private ownership is the dominant system and then make baseless accusations, focusing only on exploitation to stir emotions. So when people study Marxist philosophy, from a philosophical perspective, personally, I would subjectively suggest going step by step. Start with the Economic and Philosophic Manuscripts of 1844. It is the foundation and starting point for all of Marxist thought. Then move to the German ideology or the Theses on Feuerbach, then to the Critique of the Gotha Program, and only then, finally, to Das Kapital. Otherwise, it's easy to create misunderstandings and be misled by others, forming a so-called sometimes left, sometimes right viewpoint. And here, I must apologize to everyone because I've always believed that if people misunderstand something, it's not their fault. It's definitely the speaker's problem, which means it's my problem. It's because I wasn't thorough enough when I jumped straight into making videos on Das Kapital. After this Das Kapital series concludes, I will gradually make videos following the reading order I've laid out. Perhaps then, when you re-watch this Das Kapital series, you will have different insights. Okay, let's get back to the main topic. Just now, we clarified the basic operation of interest-bearing capital. Now, let's go deeper to see how it circulates and how it uses value appreciation to generate proliferation. First, the formula for interest-bearing capital is MM. Unlike the circulation of money capital, which we've discussed before, it features M twice, meaning it involves two turnovers of money and has no production process. Capital, this means, does not participate in production, but can still appropriate and even dominate surplus value. Let's break down this process. First, the money capitalist lends money to the industrial capitalist. Then, the industrial capitalist uses this money to buy the means of production. Through production, or circulation, the capital's value is increased to M, that is, M plus delta M. This includes the surplus value. The industrial capitalist returns M, including interest, to the money capitalist, completing the second turnover of money. This MM process differs from the normal circulation of capital because the first transfer of interest-bearing capital is a loan relationship. For this cycle to function, there are two prerequisites: the production process and the legal system. First, it must be built on a legal system where the debt relationship is institutionally recognized and protected. Second, we can understand it as a kind of parasite. It is dependent on the production process. If there's a problem in either of these two links, the cycle cannot be completed. For example, if there's no law guaranteeing that loans must be repaid, then the term interest-bearing becomes meaningless, as there's no way to legally recover the funds, or if goods can't be sold, or there's severe overproduction, the factory will go bankrupt, and the liquidated loan amount will become a bad debt. There will also be no way to recover it. These two characteristics also explain, from one perspective, why, once a financial crisis erupts, the first thing to collapse is usually the credit system. Once faith in credit collapses, even if real production capacity still exists, the circulation of interest-bearing capital will be immediately disrupted. This is because the interest rate, unlike commodity prices, has no natural limit. It is determined by supply and demand. This arbitrary and speculative nature turns the interest rate into something anarchic. It depends on production, but conversely, due to the conflict of interest over the division of surplus value among different capitalists, it relentlessly undermines production. This disorder, in the final analysis, is still, in essence, the structural contradiction of capitalism. The money capitalist, i.e., the owner of the capital, and the industrial capitalist, i.e., the user of the capital, are always in confrontation over the division of surplus value. The owner wants to receive a high interest rate, while the one who borrows the money wants to use the lowest possible cost to complete the capital's appreciation. Everyone wants a larger share, which leads to conflict. The more intense the conflict, the more chaotic the order. The entire system becomes more and more prone to speculation. This is a self-perpetuating disorder, and also the historical precursor to financial capitalism. It's also one of the fundamental reasons why the U.S. once championed deindustrialization. Please note, the disorder mentioned here doesn't mean it lacks upper and lower limits. Rather, it refers to its high degree of randomness, speculation, and volatility. Its upper limit is the total profit. In special cases, it can be exceeded, but this is an exception. If the interest rate equals a total profit, the industrial capitalist would be working for nothing, effectively working as an employee for the lending capitalist. As for its lower limit, although there is no absolute floor, and it can approach zero or even become negative, countervailing forces in the market, like competition and supply and demand, will prevent it from falling indefinitely. Between these two limits, the interest rate exists in a state of instability. Note that this instability is relative to commodity prices because it is determined almost entirely by the supply and demand of the market and by competition between different capitals with an extremely wide range of fluctuation. Unlike commodity prices, which have a clear price of production as a floor, for example, in prosperous times, capital is abundant, as everyone is making money. The economy is booming, and there's a large demand for capital to capture market share. The interest rate usually stays low. During a crisis, nothing can be sold. People panic and need to pay off debts or cut their losses, so they urgently need to raise capital. At this point, the interest rate soars, and during a period of stagnant economic recession, large amounts of capital lie idle. Few dare to invest, and the interest rate drops very low again, even approaching zero. Within this, there's a type of person who doesn't live by labor, but by living off interest. These are the people we often call rentiers. I want to ask you all, since they live by this profession, what methods will they use to increase their income? There may be many specific answers, but ultimately, they all converge on one main direction: consolidation, until a privileged class is formed. Because for them, the more capital they hold, the more money they can lend, and naturally, the more interest they collect. This is why rentiers will gradually form their own class. Similarly, you can also understand the role of private banks in that era. That is, to concentrate society's idle capital and provide it to capitalists or individuals in need of funds. But this, in turn, forms a contradiction. Initially, they consolidate to obtain more profit, but it is precisely this concentration on both sides that increases the total supply of capital in society. The inverse result is a fall in the interest rate. Looking at it this way, would you think that the interest rate seems to have an intrinsic natural law? No. No, it does not. This is precisely the point Marx criticized. In other words, the so-called natural rate of interest is a deliberately fabricated concept. It doesn't exist. The so-called natural law is just an attempt to disguise the supply and demand relations of capitalism as an inevitable law. This disguise serves the interests of the capitalist class by making people accept the legitimacy of the interest rate. Here, let's delve a little deeper. Do you remember wages, which we discussed before? They have an objective basis, the value of labor power. Or take land rent, which we haven't discussed yet, as it's a topic for future installments. But you can look into it beforehand. It also has an objective basis, the scarcity of land. But the interest rate is entirely the result of the division of spoils between two types of capitalists. It has no natural standard. It depends entirely on the negotiation between the two parties. Therefore, unlike land rent or wages, it has no objective basis. In the original work, Marx even gives a humorous example of a philosopher, namely Karl Groen. In one of his books, I won't mention the title as it's a bit sensitive. Those who are interested can check the original work. He said that the interest rate should correspond to the annual growth rate of trees in a forest, about 3 to 4% in Europe. Marx mocked this view, calling it the primeval forest interest rate. Of course, with our modern understanding, this is ridiculous. But at the time, especially before the financial system was established, such bizarre viewpoints were actually quite deceptive. But it also reflects, from one angle, the madness and distortion of that era. To make exploitation seem more reasonable, to make it look like a complete, natural system, even such nonsensical, dreamlike views could become pillars of a theoretical system. But ironically, sayings like "you'll understand when you're older" are just as deceptive. How is that any different from this kind of cover-up? They all shift the blame for contradictions onto education, onto society, onto morality. To say that the times are progressing is correct, because before, people used concrete things, like trees, for their cover-ups. But then they discovered that people would actually go look at the growing trees to refute them. So they switched to using concepts that seem reasonable, but are abstract, to conceal this injustice. One must realize that abstract concepts are extremely difficult to disprove. Everyone has their own interpretation. How can this not be considered a form of progress? Initially, humans created money, but then created a power in its purest form. People began to be compelled to pursue this power. And so money, in turn, came to dominate people. For the workers of that era, how to survive was the primary concern. As for the capitalist, how to maximize the use of money to make more money was the primary concern. And this relates to interest and profit. First, the interest rate has a degree of uniformity. That is, at the same time and in the same place. The interest rate is uniform or extremely close. This might sound a bit abstract. So for example, whether it's an industrial capitalist opening a factory or a real estate developer speculating on property, as long as it's on the same day, at the same time, in the same place, and in the same market environment when they borrow from a bank, the nominal interest rate they face is usually the same, or extremely close. The interest rate might change the next day, but they still repay the debt based on the agreement at the time of the loan, not according to later fluctuations. But profit is not like this. Profits in different industries are different, production times are different, and market competition is even more varied. Therefore, we can observe a phenomenon. That is, the industrial capitalist must consider many factors, while for the money capitalist, it's very simple. They just need to put out money and collect a fixed interest. Moreover, they don't need to consider production risks. Their profit is comparatively much more stable. This is also why industrial capitalism inevitably develops into financial capitalism. Because the core purpose of capital is growth, the production process is merely a means, not an end. When a simpler, more efficient, and lower risk method appears, it will inevitably replace production. This leads to the power of financial capital growing ever stronger to the point where it becomes non-productive, yet still controls production. Here, let's explore this more deeply. First, for the worker, his situation is LM. Labor power, money, commodity. As for the industrial capitalist, his situation is M. CM, money, commodity. Production, more money, and the money capitalist is MM. these three parties ultimately transform into a relationship of domination. The money capitalist dominates the industrial capitalist, and the industrial capitalist, in turn, dominates the worker. Ultimately, this forms a power structure where money dominates everyone. The entire society operates around the principle of money making money. Now you can understand why. The closer capitalism gets to its so-called advanced stage, the greater its structural contradictions become, the more deindustrialized and internally hollowed out it becomes, because everyone is trying to find ways to profit from speculation. Everyone comes to believe that money seems to generate more money by itself, that just by lending money, one can effortlessly and continuously collect interest. This is more important than any productive activity. This is the highest form of commodity, fetishism. But in reality, interest depends on production. And production always has limits. Debt cannot fundamentally expand infinitely. I don't think it's that they don't know these things. It's just that they don't care, because they can use one ideology after another to declare to the public that making money is a fundamental truth, that the capitalist's income is well-deserved, a just reward for the hard work of managing and supervising workers. How can that not be considered a form of labor? Workers and capitalists are not in opposition. One should be grateful that they provide jobs for workers. The reason these ideologies can captivate the masses, time and time again, is that, aside from private ownership leading to unequal status, it is, more importantly, very difficult for workers to find the root cause. Like we just discussed, the capitalist works hard managing and supervising workers. How can that not be considered a form of labor? At first glance, this seems correct, but if you get to the essential root of it, you'll discover that he is merely organizing a form of exploitation. It's an ideological justification because supervision and management that truly and directly serves the production process has the purpose of improving efficiency, ensuring quality, and providing goods for society. It aligns with the interests of the workers, aligns with the general needs of society, and aligns with capital, achieving a three-way consensus. It can also be separated from the capitalist's income. This is a true form of labor, but when management is a disguise for exploitation, it's more akin to control, treating people as tools, and using every means to force them to prolong their working hours and increase their labor intensity, to squeeze out more surplus value. They even want to work one person like they're two to maximize their own profits. The core purpose of their so-called supervision and management is to ensure workers do more work for less pay in order to increase profits. It's not purely for the needs of production. This is precisely what Marx referred to as the dual nature of the labor of supervision. Besides these things, education is also a very important factor. As we mentioned in Volume 1, capitalists are especially on guard against the children of workers receiving an education, even finding every way to obstruct it, because they are afraid these things will be exposed. They want to pass these notions on through the parents from one generation to the next. That way, their descendants will not only defend this ideology, but will also fantasize about concepts like money can make money and the boss must surely earn a lot of money in order to give themselves the hope, the fantasy that one day they too can become capitalists and tread on others. And so, they are trapped in a small, distorted world of human making, yet can never discover the fundamental truth that labor creates value until they, in turn, become parents to the next generation. Of course, the education we speak of here is genuine education. The bourgeoisie realized very early on that this kind of education has the potential to break their domination. Therefore, they will also deliberately find apologists. In the original work, Marx criticized quite a few books of this kind. For example, Dr. Price, in his observations on reversionary payments, justified and romanticized the idea of money begetting money. He even dragged the solar system and God into it. He said that 1 shilling, loaned at 6% compound interest in the year of Christ's birth, would grow into a mass greater than what the entire solar system could contain, assuming it were a sphere with a diameter equal to that of Saturn's orbit. Therefore, a nation can always escape its difficulties, as a small fund could pay off the largest debts in the short term that its interest demands. Marx quipped that for the English national debt at the time, what wonderful theoretical guidance this was, because he completely failed to mention the actual conditions of production. The so-called growth in numbers comes from the surplus labor of workers. And along with capital accumulation, the rate of profit also tends to fall. It is not constant. But the most ironic thing is that the British Prime Minister at the time, Pitt, believed Price's theory and thought this growth could automatically eliminate the national debt. He then enacted absurd fiscal policies. And so we saw that Britain's debt level at the time did not decrease at all. On the contrary, it continued to expand. To pay off debt, they had to take on more debt, ultimately falling into a vicious cycle. Perhaps you are a bit unfamiliar with the concept of public debt. Let's explore it a bit more here. First, it's a type of fictitious capital. In layman's terms, it has no real value basis, but it can generate an income. You can also understand it as a certificate that uses national credit as a guarantee for a promise of future returns. For example, the government issues a $1,000 bond promising to pay $50 in interest each year. If the market interest rate is 5%, then this bond is worth $1,000. But if the market interest rate falls to 2.5%, the bond's value becomes $2,000. Does that feel wrong? It's very counterintuitive. How is it that the lower the interest rate, the higher the value? You said it backwards, right? No, it's not backwards. Let's clarify two concepts first. First is the nominal interest rate. It is fixed. For example, your bond certificate promises to give you $50 in interest each year. This is clearly stated and does not change. The second concept is the market interest rate. It changes constantly. This is very easy to understand. Now, let's combine these two concepts. This will give us the value of the bond. It depends on how much cash flow it can generate in the future, i.e., how much it's worth. Let's revisit our previous example. When the market interest rate is 5%, the bond in your hand gives you $50 a year. But in the current market, other people who invest $1,000 also only receive $50 per year. Therefore, people will think, this bond gives me $50 a year, which is on par with the market rate. A value of $1,000 is fair. At this point, the bond's value is $1,000. But if the market interest rate suddenly drops to 2.5%, then money in the market now can only earn a 2.5% return. In other words, if someone else wants to have an annual income of $50, they would have to invest $2,000, because 2,000 times 2.5% equals 50. But your old bond only required a $1,000 investment to get that same $50 a year. So at this point, congratulations. Your bond has appreciated in value. So people in the market would be willing to pay a higher price to buy your bond. They might pay up to $2,000, at which point its return would be on par with the market rate. Now, the bond's value is $2,000. Have you realized? Money is not static. Its time value changes with market fluctuations and interest rates. You can see the interest rate as the time value of money. As for the value of an instrument, with a fixed future income, like a bond, it depends on how much money people are currently willing to invest to earn that future $50. Therefore, when interest rates are high, people value future money less, and the bond's value is low. Conversely, when interest rates are low, people value future money more, and the bond's value is high. After understanding these points, you can also understand what stocks are. In itself, it's really just a piece of paper or an electronic certificate. It represents an expectation of future profits or losses. We can make judgments based on the company's business situation or various international conditions and then choose to buy or sell. It's more like a game of confidence. Therefore, you might notice that the stock price of a listed company can fluctuate wildly in a single day, but its actual assets haven't changed. Correspondingly, this is the core of fictitious capital. That is, it doesn't represent any real wealth. Its price can even become completely detached from its corresponding real value. This means it's highly susceptible to speculation, meaning through public opinion, combined with various financial instruments. Worthless paper can be turned into cash. This is what we commonly call a bubble. But once the bubble bursts and confidence collapses, the stock will turn back into worthless paper. Therefore, the credit system is effectively a double-edged sword. To ignore it would be unrealistic. The crucial point is who uses it and how it is used. Without a credit system, Our modern economy basically could not function. But under the logic of private ownership, it makes the polarization between rich and poor increasingly severe, because it forms a kind of class privilege, a privilege that is almost frenzied. As Marx wrote, credit is the most perfected form that the capitalist mode of production achieves. It transforms private capital into social capital. And once it reaches this point, all forms of exploitation undergo a qualitative change. Financial capitalism exploits both labor and industry, and even exploits the government itself. It will first, through its control of credit and finance, privatize all infrastructure related to basic necessities, like food, clothing, transport, healthcare, and education, until monopolies are formed. Then, on top of the existing exploitation of industrial capitalism, it relentlessly raises the cost of living, pushing people into maximum debt, even making people use their entire wages to pay off debts and buy monopolized basic services. This is tantamount to appropriating a person's future value in advance, and can even succeed in extracting the entire value of a human being from birth until death. And workers no longer dare to organize unions or go on strike, even willingly accepting all kinds of oppression and terrible working conditions because they're afraid of losing their jobs and source of income. If it really comes to that, not only will they lose everything they gained through debt, but they will also continuously incur late payment fees. Tell me, are human beings intelligent after all? Animals, at most, can only maintain contact with a few dozen of their own kind. But humans, relying on imagination, myths, stories, and concepts, have divided people into all sorts of ranks and classes, making them both compete and cooperate with each other. I think they're intelligent. So intelligent that even knowing those concepts aren't natural, but are man-made, they still, day after day, year after year, parrot the phrase "it's always been this way." So intelligent that they can cry injustice, while rushing to become part of that injustice. So intelligent, they turn exploitation into gratitude, debt into responsibility, and hardship into normalcy. So intelligent, they equate freedom of consumption with being a free person, making people truly believe that consumption is freedom. Tell me, are humans contradictory or not? Clearly, they know that if each part has value, then the whole will have value. But at the same time, they place their hope in the whole, while greedily destroying its individual parts. They scold others for being materialistic, yet claim to be just a common person full of desires. They believe our future will be better, yet at the same time, they ceaselessly teach the next generation the tricks and the joy of never being taken advantage of. Tell me, are humans animals that dream, or animals that only know how to deceive themselves? Are humans animals that pursue meaning, or animals skilled at making excuses for absurdity? Or perhaps you could tell me what, in the end, a human being is.